Hey traders, welcome to another Performante podcast. This is take two here. I unfortunately fucked up the stream, so we couldn't get Nathan to actually be heard, but we changed the settings, we got it to work. That was my bad on that one. So the topic of today is going to be recessions, and I'll hand it over to Nathan.
Yeah, so today we're going to be talking about the dirty R word that everyone's been saying recently. We're going to talk about what a recession looks like, what you can expect from a recession, how to prepare for a recession, and the role that cryptocurrency plays within a recession. But before we get started and dive into the technicals, I just want to iterate that this is not financial advice. The Performante team does not have any professional financial training. We are not financial advisors. The information we present is experiential. We learn, we listen, we watch videos in our free time. We seek out as much information as possible, and we present it forward in an unbiased manner such that you can make your own choice. The decision you make should be your own.
Yeah, definitely a very important topic to discuss. Proper due diligence is very important, and having information about a topic, especially investment related, is very important. I think this is a good time to talk about it because when there is a lot of volatility, there's many people who try to beat the market in a way and just say, oh, I assume that the market is going to do ABC without any real knowledge. And that is gambling, and that's not what we're trying to do. We're trying to create a system in a way that is a dependable, repeatable, systematic approach to navigating the markets, and that's kind of what we're about.
Exactly. We're just trying to provide the information for you to form the framework of your own decision. And with that in stride, there's been a lot of volatility recently. Maybe you got burnt by the recent Robinhood outages. I know a lot of people couldn't make the trades they wanted to make, or the orders weren't submitted. Hopefully we found a solution for that. If you are a U.S. equities trader, we've become a Webull affiliate. So if you do want to take advantage of this offer, you'll get 2 free stocks. Just navigate over to our website, performante.ca, same as our Instagram handle, and click this free stocks button. Here you'll get taken to register for a Webull account. You get 1 free stock for registering, and you get another free stock for funding it with any amount of money. It doesn't look like the coupon wants to load, unfortunately. But yeah, you get 2 free stocks. Check them out. Commission-free trading for stocks, options, ETFs, bonds, and other features will be coming soon in 2020.
Yeah, that'd be really interesting when crypto becomes available to there. Yeah, you can't really beat commission-free trading. That's a pretty phenomenal opportunity for sure, especially if the competitor is not really able to provide that the consistent service that I guess Robinhood is unable to do. I guess every 4 years because of the leap year. But
yeah, leap years get the best of them.
Yeah, that's funny how that works. But I think our next topic, definitely a good intro. We will then now dive into the kind of meat of the podcast, which is going to be talking about recessions, which is what Nathan pulled up right here. So this is the Investotopia definition of a recession. A recession is a macroeconomic term that refers to a significant decline in general economic activity in a designated region. Now, it's typically recognized after 2 consecutive quarters of economic decline, as reflected by GDP in conjunction with monthly indicators like employment. Recessions are officially declared in the U.S. by a committee of experts at the National Bureau of Economic Research. By the way, they're always late. They're the last people to call it a recession out of everyone. Just saying. That determines the peak and subsequent trough of the business cycle, which demonstrates the recession. So basically, It's just when the economic cycle slows down. It's not a depression like we had in back in the 19 or I guess 30s, no, 40s, because there's the roaring 30s and the Great Depression in the 40s. But it's definitely something that I think is it's not something that I think it's inevitable, right? It's a business cycle. It ebbs and flows. It's because of having credit, right? If there was no credit, it would just be what was it called? It's when there's three business cycles. There's a long-term debt cycle, short-term debt cycle, and then there is give me one moment here. It's when there's the only growth that's only going to be coming is from actually productivity growth. That's what it's called. So there's three, I guess, lines of different growth. There is long-term debt cycle, short-term debt cycle, and then there's productivity growth. And if you didn't have credit, you wouldn't have these ebbs and flows of recessions and these peaks and troughs as much, or if ever. But because there is credit, which can be a good thing if you are borrowing money to grow your business. For example, if you're a farmer, if you borrow money to purchase a tractor, so then you can grow more crops, so then you can sell more, and then you can pay off that tractor. Obviously, credit is a great way to grow a business and grow an economy if it's used properly. But if it's used improperly, like buying goods that will not pay for its credit, like buying a TV, buying a car just for the sake of having a nice car, then credit is used improperly to some degree. Or buying a house would be a proper use of credit if you're going to rent it out and all that stuff. So definitely something to think about. Got a little bit off target there in terms of the topic, but I just wanted to illustrate what the Investotopia description of a recession is. So in that said, I think that the next topic is just to go over what even happens in a recession, because a lot of people don't really understand. But all it is going to be, in short, a slowdown in the exchange of goods and services within a particular economy. And in some cases, it is a global slowdown where it's not just a particular region, like a particular country, but it is a globally impacted slowdown in the economy, looking at all corners of the globe. And we've had them before, and it is looking like we are setting up for one upcoming soon here, because you see a lot of first world countries around the globe have not much left in terms of ammo that the central banks have. And we'll go over it a little bit later on in the video or in the podcast. But they have a certain amount of opportunity or things that they can do to try to stimulate the economy. Like, for example, they got two real things. They can decrease or lower interest rates, or they could print money. And they're like globally, look at how many countries are in negative interest rates. So I don't really understand how people can be so bullish about the economy.
They can only do it so many times before there's very serious consequences for their actions. We're very distanced from them because relatively the Canadian dollar is strong, the US dollar is strong, but in countries that don't have that same benefit, there's very real consequences to hyperinflation. But looking just more like in the everyday life, how a recession manifests, it's people are just spending less money. There's less downward movement of money, and so as a result, the people who normally receive that money, whether it be your local mechanic, your plumber, or any kind of food service industry, those people are going to be receiving less money, so they spend less money. And so it's just a day-to-day decrease in transactions between anybody who could even participate in transactions. It's on everybody's mind. They need to reduce spending. They need to save. Things are unstable, etc., etc. It's a state of mind that people get into as from an investor standpoint.
Yeah, it's actually pretty crazy how similar people move. It's like everyone thinks they're unique in a certain way, but a lot of people move in very predictable patterns, in a sense. And in different experience levels in terms of investments, people will act in different ways. But well, at least in my opinion, I do think that because of the internet, more people are prepared now than ever in any recession, any economic downturn that's ever played out in the past, which is great because you talk to people just randomly, and they know that yeah, there's some economic trouble ahead, and I'm either hedging in gold or silver, or yeah, I heard this thing about crypto. It's going to have some sort of impact on potential monetary systems or currencies, or there's so many things that crypto obviously can disrupt and really shake up. But when people are able to understand that just through the sheer Google searching, that's really giving power to the people. And I hope obviously this podcast is kind of meant to maybe open up maybe a couple people's eyes as to the potential reality that we're facing, instead of the well, it's not like picture perfect of the news obviously showing us what we're not what we shouldn't be seeing. But I do think that a lot of things are trying to be hidden or trying to be manipulated in a certain way. Like, they have so many contradicting arguments and people who have difference of opinions for a reason. It's because they want to make everyone confused. Oh, is it bullish? Is it bearish? Let's have two people debate it. And it's great having a debate, no doubt. But when you're unsure and when you hear two people debate, well, in my opinion, that just makes you even more unsure. Instead of having a unbiased explanation of the topic, you have two people yell at each other saying, this is right, that's right. That's not really any way to go about explaining what's occurring in the world, if that makes sense.
Yeah, there's no hard and fast answer. There's always so many inputs into what people perceive as the current market conditions, that if somebody comes up to you on the streets and says, hey, we're in a recession, you can't just say no, and you can't just say yes.
Yep, so true. That's why charts are so unbiased. That's why I love it, right? A chart cannot lie. Like, and obviously you can say it's fake outs, and you could say, wow, like, the chart fucked me over. It lied to me. Which, to be honest, I felt like that at times in my life for sure. But yeah, that's why seeing the analytics, seeing the statistical data, in my opinion, is always going to be far superior than trying to read the news and be ahead of the curve by reading the news. Instead of trying to go about it that way, try to understand the underlying factors behind what's going on. So, like, look at what the analysts are looking at instead of trying to listen to what the analysts are saying, in a sense. Like, cut out the middleman so you can create your own unbiased judgment as to what you think the economy's at in terms of health, in terms of the cycle in the business cycle, or in terms of even single investments, right? So yeah, having your own opinion is very important. But so I think we were kind of done with the Investopia. So I think the next topic at hand is we're going to go over a few different tools that we use to assess the health of the economy. The first one we're going to be looking at is the dynamic yield curve. We've definitely talked about this in the past. If you guys and girls don't know what this is, it's going to represent the yield, which is to the left here, for the different yields.
Oh, I think you need to switch the video feed over.
Oh, so for...
Oh, no, we're good. Don't worry. Never mind.
We're all right?
Yeah.
Okay, awesome.
My bad. Keep going.
Yeah, that's all good. Let me just get my page here. There we go. So this is the dynamic yield curve. So we have the left side here, which is going to be the actual yield curve itself, and then we'll get into the details of that in a later video, or in a later part of the video. And then we're first going to talk about what this is right here. This is going to be the SPX, or the S&P 500, which is an index that's going to represent the 500 largest companies in the United States. We see back in 2000, we had a major market crash, rallied back up. Again, 07, 08, market crashed, and basically from 2000, started 2009, from where we currently are, it's been in a massive bull run. And then this red line that I'm dragging from left to right now is going to be the exact date that we're looking at for the chart here that is representing the yields for each bond. So this is the 3-month bond, the 2-year bond, the 5-year, the 7-year, 10-year, 20-year, 30-year treasury bonds, T-bonds, right? So normally we can see in a normal market the bonds that are the shorter time frame, the 3-month, 2-year, 5-year, are going to have a smaller yield than the larger time frame bonds like the 20-year and 30-year. And we see most of the climb most way all the way down, and then when we're at the lows here, we see that it's a pretty healthy, what you call healthy, where the shorter term bonds are going to have less yield than the larger term bonds. But when we look back and see the shift, we can see the shift occurring right now. The shorter term bonds, the 3-month and 2-year, have a larger yield than, for example, the 7-year. And if we extend it out further, we can see that the 3-month has higher yield than any other time frame bond. Now, in a normal situation, if you're going to give your money to someone for a longer period of time, you would want a higher yield. It makes sense. You're giving up your money for a longer period of time. You want more money for it. In this situation, the investors are worried about the long-term outlook of the market, so they want a higher yield at a shorter time frame. It is not normal. It's inverse. You see that the yield at the shorter time frame is higher, creating a downslope to the right side compared to basically every other time where the downslope is to the left side. So that is what you're looking for in a inverse dynamic yield curve. That's what basically people are talking to. Same thing in 2000, you see the yield curve normal, and then you see basically right at the top there, it's inverted. You see the 2-year T-bond has more yield, has a higher yield than any other bond that's greater, 5-year, 7-year, 10-year, 20-year, 30. And then what we're seeing right now, so that's 2000, and we went over 2008, and then what we're currently seeing right now is you saw the climb back up. You saw where they had artificially low interest rates. It's fixed right at the low here from basically that break all the way up. And then when they started to lift the interest rates at 2016 right here, finally started to raise the interest rates. We can see raising, and then we're starting to see a tipping point. Now we're seeing the 3-month higher than the 2-year, 5-year, and the 7-year. So we're seeing a bit of a tipping point at this stage. And then as we can go further, now the 3-month is higher than even the 10-year, not the 20-year yet. And then as we can go further, we are getting a little bit of flattening, and now we got a massive drop in interest rates basically across the board. We can see it's steady, and then we got a massive drop. Boom. We can see that right here. Big drop recently. So we'll just quickly talk about this. When you're going to have a fixed income asset, or if you're going to invest in something, look at how much money you're getting as a fixed income asset. You can't. It would be so hard to live off this if your fixed income interest rate is like 0.3 or like 1% a year. You can't really live off that. So what do you do as an investor to try to grow your portfolio? Well, you have to invest in more speculative investments, right? Because fixed income clearly will not give you sufficient returns in order for you to grow your capital. So you're going to have to go into more risky equity or equity type investments in order to try to attain that alpha, that 7-8%. And it's been working. We're in a massive bull run since 2009. But if that shifts, well, then there's a lot of people in equities. So it's going to be interesting to see what happens, to say the least. Recessions are not pretty. Like in the movie The Big Short, every time the unemployment increases by 1%, 40,000 people die, or something along the lines of that, right? I forget the exact quote, but
for every winner, there's a loser. And in these kinds of situations, the ultra rich people are losing billions of dollars per day. Like Jeff Bezos lost $7 billion overnight. Like, yeah, that sucks, but he can cry in his mansion while other people like lose their jobs, can't afford mortgages, etc., etc. Like, there's two sides to every coin.
Yeah, that's the tough part. But then, like for example, the stuff that we posted on TikToks and people say, "Oh, you're doom and gloomers" or whatever. There is going to be a recession. It is inevitable. You can't have a forever expansion. It does not exist. People have tried. It's impossible. You can't just have a forever expansion. You can't forever hold your. It take more and more breaths. Like anything, the market has to breathe, right? So. It is a natural part of the cycle, and the sooner you are, or sooner someone is able to accept it and then embrace it, the sooner you are able to potentially capitalize on it. Because, recessions are probably one of the best opportunities for people to leapfrog from uh, not one status, but like from one certain wealth class to another in a sense. Like if you're able to capture that swing, that transfer of wealth, that can be completely life altering.
Yeah, 100%. Like, there's a very real opportunity ahead of us. But I just wanted to plug our blog real quick. We've been posting on our digital finance blog. And if you did want to learn more about these things that we're talking about, like the Federal Reserve cutting rates, how to prepare for a recession, etc., you can find this on our website. And it's just another way that you could further your knowledge if you do want to learn more about the subject.
Definitely, some really good reads there for sure. I think did you want to go into any of them, or did you want to go into a
Should we
few?
dive into some TA?
Yeah, for sure. I was going to say that next. So let's for sure let's go into some TA here. Oops, let's just go here. Duplicate. First chart we are going to be looking at is going to be the SPX, which is the S&P 500, the 500 largest companies. It's an index, so we're going to go all the way back to the monthly chart. Now, as we can see, let's go like this. On the log chart, we can see we've been on a monumental roar. From basically 1971, we saw a massive move to the upside, and we saw the huge bull run from 1994 all the way up to 2000, April of 2000, over 240% move, and then we got our correction, right? So they're normal. And then we got our key level of resistance initially, and then we had the dot-com bust, which was from basically September '01, and then the low was in August of '01, and then from the lows there, we climbed all the way back up to the recent highs. As we can see right here, basically we hit the exact same high, and then 2008, we double topped, as we can see, and then we fell very, very significantly, over 52% at the lows there. We had a pretty speedy recovery. Now, this was due to two things. One thing was artificially low interest rates. They dropped interest rates to near zero and kept them there for 5-6 years. I think it might have been 7. I think it was until 2016 when they started raising interest rates. So they had artificially low interest rates, and they implemented 3 series of quantitative easings, which is basically, to put it simply, quantitative easing is printing money out of thin air and buying financial assets within the marketplace, buying equities, bonds, you name it, major financial assets, and they're trying to stimulate the economy by just basically printing money and buying stocks and bonds. So, just basically massively growing the balance sheet. And that's how they got the stock market to rally back up so quickly, is they lowered interest rates. So it really, really tried to stimulate the economy through ease of borrowing and lending. So then if you're a borrower, if you're a borrower, if you want to borrow money, you're able to do it very, very cheaply. So then it tries to stimulate business activity. If you're a business, you'll try to borrow money because there's lower interest, so then you can spend your money on growing the business. So then obviously that's good for the economy. And then that also in line with just money printing, buying financial assets, making the stock market go up, making people feel richer because their stocks are going up. That obviously, like we talked about with Nathan, the feeling of being richer, seeing your portfolio increase in value, seeing that appreciation will make you feel richer. You'll want to go out more. You'll maybe want to buy that new car. You'll maybe want to buy that nice shirt that you saw. You'll maybe want to go on that vacation. You'll maybe want to do all these things that is providing money and providing an exchange of goods and services to other people, which is their payment and their earnings. So then they get more money and the whole system gets circulated, and obviously that's how an economy grows. So to get back to it, that's why we got that massive surge in volume, and what we're seeing right now is a pretty well top, right? So if we're just talking about market structure in terms of distance here, we can see from the low here to the high around 100%. Right? From the mid-range zone, the previous resistance to the high, right, is around 100%, right? Around 100%, right around here. So just structurally speaking, that's pretty damn similar, right? We could go like this, right? That was a low that we went off of. We're going to define that a little bit more, right? That's the low that we went off of for the 100%. Now, doesn't that look like such a nice market structure high? Well, I'm pretty sure it does, in my opinion, because we see a nice even zone. And I'm sure if we got another area to go 100% below, it'd probably line up with the key zone as well. So we're not going to 100% say, yes, this is guaranteed to be a recession, but just looking at some ascending zones, like we're not going to dive too deep into it, but we're just trying to give an illustration, trying to look at the larger macro view of what's happening here. You're seeing these ascending zones. This is a very large ascending zone we can see. Started all the way from up here, right? This zone right here. So if you're looking at the larger view, it doesn't seem crazy, right? You're getting... That was a little bit wild. Just quickly, just talking about it. You're getting an ascending zone that is holding a price, making a higher lows. It breaks. Now we start making lower lows and lower highs. Same thing. You're seeing higher lows, holding an ascending trend line. Once you get 5 or 6 touches of a trend line, at least 4, then it's a dependable zone. It breaks, pulls back, retests, makes a lower high, making lower lows and lower highs. Might want to manage your risk. You never know. I understand if you're long-term holding, 100%. If you're willing to hold for the next 40 years, don't sell. 100. I commend you for never selling your stock and only living off of the dividends. I commend you for that. But if you are a person who wants to, use their investment within the next 2, 3, 4, even 5 years, the drawdown on this pullback will be significant. The drawdown from 08 to the high was 5.5 years. Now this, you can expect, would be probably something similar, if not more, because the central banks just don't have as much ammunition. They were able to lower interest rates when the price dipped, so then the stock market could rally. They were able to print shit tons of money. Can they do that again? Will that hyperinflate the US dollar? Who knows? We might see. And they do know that is a severe consequence if they just print the US dollar to oblivion. So we're in a tough place. I'm not going to dive in too much with the charts here. I just thought that looking at the monthly, not looking at the tiny 1 hour, 15 minute, 5 minute, even 1 minute time frames, looking at the monthly, looking at the weekly gives you a much better overview of the overall structure of the macro view. And right now we can see we're not making lower lows and lower highs on the monthly time frame. Right now, we're not seeing that, right? We're seeing this is a low. This is the previous major low at 27.46. We can see back in 2008, we were making a higher lows, and this was a lower high, and then we saw another lower low. We saw a low, a lower high, a lower low, and a lower high. You're seeing lower lows and lower highs. You're breaking ascending zones. You're breaking supports, holding resistances. Same exact structure here. You have a nice ascending zone. 1, 2, 3, 4. So it's a dependable zone because you have 4 areas where the price is touching. And then you start seeing lower lows and lower highs. You could save yourself a significant amount of money here if you're able to just manage risk. And like I say it again, if you're a long-term investor, it totally makes sense. But if you're thinking about using the capital in the next 2, 3, 4, 5 years, it makes sense to manage risk. So same thing here. You need to see a lower low formation. Ideally, you're looking for a break around this zone. So once you're able to see that lower low, and if it breaks and holds the lower low, and if it breaks the ascending zone, horizontal zone, and then it's able to hold the lower high, holding a previous resistance support as a new resistance, then obviously you're going to have a bias to the downside. So we'll keep everyone updated on this. We'll go over the S&P 500, but I don't want to make people fearful, but as a technical trader, this just seems like another one of those or another one of those. So I'm not going to dive in too much more. I could talk about this all day, obviously. Love talking about the charts, but hopefully that gave you a little bit more insights.
Yeah, it's from a technical standpoint, it is definitely intimidating, but in the same note, it's an opportunity, right? Because this is a transfer of wealth. There are going to be rich people getting poorer. There's going to be discounted equities. There's a lot of opportunity that comes with a recession if you can put yourself in the right position. And the principal way you can do that is you have cash on hand and you have cash flow. Like Grant Cardone says, cash flow is all that matters. You need to have an ability to capitalize on these opportunities around the market in order to actually make a play from a recession. Like, you can't make any money if you're a broke boy in a recession, so to speak. So
Truth.
that you really gotta formulate ways that you can be able to invest, whether online side hustles, you have a good job, get educated, do whatever you need to do to make money, but proper planning and even better, proper execution can and will change your life if you do it right.
Yeah, 100%. That is, you couldn't have said it better. And it's not easy, right? It takes a level of discipline and commitment to start saving money if you're working hourly. If you're working at a job that doesn't pay you significant amounts of money if you're young, it takes a level of commitment and discipline. And it also takes, what I found is a lot of delayed gratification, where you want that item now, but you would rather use that money to trade it, to invest it, to grow it, and then it's not for the faint of heart. But delayed gratification, discipline, and just being always seeking knowledge in terms of how to A, improve yourself, and B, learn more about what you're trying to know more about. For example, in the financial markets, you gotta always be consistently trying to think, how do I not even get better, but how do I broaden my knowledge in a way that will help me in my lifetime? Not just how do I get this quick stock, as a quick stock pick to make $50 for the day or whatever your goal is. Instead of looking at it short term, like, take a step back and think, okay, I have one life and I want to be financially free in this one life. What information do I need in my life to make that happen? And approach it through those means. Instead of thinking, how do I make a quick buck? How do I make a quick $1,000? How do I set up my knowledge base and my knowledge bank in a way that allows me to navigate the markets, to capitalize on these situations? And it takes a lot of time, but yeah, having people around you that have similar goals is very important. That's kind of why we have our Discord. Is like I didn't have that many people to really have that discussion with, really. So then obviously with Performante and in the team, I've gotten to a point where I talk about this very frequently with the team as well as our students. Yeah, if you are interested in this sort of information, if you feel like you'd like to know more, but you'd like to kind of have a discussion even before diving in, because obviously there's a lot of questions that come with it, we are always open for that conversation.
Anytime, every time. Our Discord's always open. We love to chat. There's a lot of different perspectives on the Discord and a lot of different types of traders, so it's always good to get an alternate perspective if you ever do have a question. But that calls into question, how exactly do you capitalize on a recession? Like, what are the strategies you need to be implementing? In the wise words of Warren Buffett, be fearful when others are greedy and greedy when others are fearful. I guess what he's insinuating here is that you need to go against what the rest of the market thinks. If people are thinking recession, you need to be buying. If the market's reaching all-time highs, you need to be selling. It's that kind of mentality of playing one step ahead that can really get you ahead, because if you've been a long-term investor and you are not holding for 40 years and you rid the bull market to 3,300 on the SPX and you didn't sell, it's you put yourself in a very interesting predicament by doing that, because if you're not willing to hold your equities, your investments for long periods of time, but you're not willing to sell them, what are you doing with them? Because there are lots of ways that you can use that excess cash, excess profit in a recession. That's the primary way that you can capitalize on a recession, right?
Totally, 100%. Yeah, you need money to make money. Investments, just multiplying whatever you have in a sense of just capital. Yeah, like I said before, it may not like for people who are just working like a normal job, just kind of like if, I know we have a younger audience. If you're still in high school or going into college and or university and you're working a normal job, like it takes discipline, but you will thank yourself because every single person who has grinded, put their goals and ambitions in front of materialistic short-term objects that will be inhibiting them from actually gaining a level of success that they're wanting, is a sacrifice, and it just is something that people who want to see success have to live through, is having sacrificed time and money as well. Like for example, if you're spending a lot of time on something, it is definitely another risk as well. So I think the best way to go about it, if you are a complete novice, a great first step would be to understand what dollar cost averaging is. And what is dollar cost averaging? All it is purchasing or investing a certain amount of money every single week, bi-weekly, monthly, quarterly, whatever it is, but you set aside a percentage of your income or a dollar value that you don't care if the market is going up, down, doesn't matter. You're going to, let's say, invest $100, $1,000 a month into, for example, the S&P 500 index, whatever you're investing in BTC, but being able to stick to this regimen and stick to this system allows you to not get the market swings and get emotional by making wrong choices. If the market drops, you might sell, which is not the right choice if you're just in a trending market. So being able to dollar cost average if you're a novice investor, I think is a great way to start entering into the market.
It removes emotion from the equation and just allows pure statistical efficiency to take over from your investment. You don't have to worry about it. Should I buy in now? Should I buy in later? Make it scheduled, remove emotion. Simple as that. But that also calls into question what you should be in dollar cost averaging into. So in situations like this, a lot of analysts will talk about asymmetric non-correlated assets. That's a buzzword. And what that means, asymmetric means that it has good risk reward. Generally, it goes up in time. So right now, up on the screen, we've got gold pulled up. And so the other part of it is non-correlated. Well, non-correlated to what? Non-correlated to the rest of the market. Meaning, if you were to look at like the S&P, Dow Jones, etc., gold in this case is not correlated. They don't move in the same fashion, and you can't expect them to be in similar market cycles.
Not perfect, but don't really get a really good comparison. What if we try SPY? No, it's not really a great compare. I guess you can kind of look at it in that sense. I think that's a better comparison right there.
You could also add silver in there.
Yeah, let's do that. Compare. Whoa. Silver is definitely a lot more volatile. There we go. So I think it would definitely be safe to say that they're definitely uncorrelated. Gold and silver obviously are going to be very correlated because they're same precious metals. They're not going to be directly correlated. But I'm just going to take this off and then compare silver first. So then it's at the top. And then we will do SPY. And then go log. Okay, the SPY is still there. But regardless, we can see that there's definitely not a real correlation between precious metals and the S&P 500. And they're well known for that, and that's why people go and try to invest in them when there is economic instability within the market. And what a lot of people are speculating now is that crypto, and especially Bitcoin, is like digital gold. It's gold 2.0. There is going to be a fixed supply like gold. There is, unless you do get massive gold pockets. That has happened before, but overall there is a pretty general good amount of supply that is coming into the market at a pretty reasonable rate, unlike the fiat currency that we're currently seeing. So there's a lot of comparable situations that we're seeing with gold and crypto. But I think one thing that we do have to consider is the fact that if you're actually looking at gold as an asset, not looking at it as a asset that you can back a certain currency with or even a cryptocurrency with, but gold in itself is not very fungible, and it's not very transportable. So in terms of using it as money, it's not really amazing. It holds value very well, which is great. But in terms of being able to transact with it, like let's say you wanted to buy a car and the car was, like some amount of gold, and you had 20 ounces of gold. Well, how you gonna heat it, melt it down, chip it to the exact amount needed, and then give it to... That's not going to work, right? So then, introduction to BTC, well, then you got a fixed supply, you got a amount of... You have 21 million, that's all there is going to be. Period. End of story. So this chart is BLX. This is the longest running chart on TradingView that we have of Bitcoin, and as you can see, from 2011, we basically went up over 9,000%. I think it was. I can't even see. 14 million percent, I think it is. 14.4 million-ish percent from October 2010 until basically now. So, if you're talking about looking back at historic price action, well, why would you not want to have a part of this? Doesn't make sense to me. Why people think it's a stupid investment.
Look at the lows, not the highs, people.
Exactly. Even looking at the retracements, they're pretty significant retracements. 79% from the high of maybe 18, 19K to the low of 32, 83%. But like Nathan said, look at the higher highs and higher lows, and we're growing significantly. And just bringing this all together with what we've already talked about, with the global health in terms of economics, not looking great. Look at how many countries are in negative interest rates. Look at Germany, look at Switzerland, look at Japan, look at Denmark. There's so many countries that are already in negative interest rates. Trump has already talked about either zero or negative interest rates. So it just seems like everything is coming together. Unfortunately, saying coming together because talking about and discussing recessions can be a little depressing for people who are looking at the long-term scope, especially if you're talking about potentially losing a job or whatnot. But at the end of the day, it's an opportunity for people, and that's what we're trying to provide is unbiased opinion and an explanation of why we think the outcome is going to turn out the way we think we do. And to keep it very short, we think that there's going to be an economic recession globally, not just the US. Even in parts like Japan, China, Australia, Europe is already suffering. Japan's already in a deflationary spiral. China is seeing a lot of challenges recently, obviously, with the coronavirus, and the US as well. So we do think that there's going to be some level of a recession in the short-term future. And with BTC poised to see the BTC halving, is in a current position where there is a lot of interest as a safe haven asset. Cryptocurrencies, including Bitcoin, have never been better in a position to see that demand from not just retail, but also institutional money. So I'll turn it over to Nathan to wrap it up here.
Yeah, there's a lot of different factors in play. Recession seems like it's starting. We're just trying to integrate the technical factors into a cohesive manner so that you can make your own opinion. Because, like we said at the very beginning, you should be doing your own research and integrating data from as many sources as possible through what you think is valid. Because you need to develop your own understanding. And that's something we firmly believe in, and that's something that we practice with all our students. Yes, Performante Premium is an option to earn while you learn, but we advocate that everyone goes through the materials that we provide, goes through the video lessons, the PDFs, because before you get involved in any financial market, you need to understand what you are getting involved in. Failing to do so is pretty negligent. And that goes true with even all this recession talk. Like, you shouldn't be blindly following strangers' advice online. You need to build your own understanding because it's a complex world out there. Not everyone always has your best interest at heart. Besides us, because we just provide the reputable information. Alrighty, shall we end it there?
Yeah, I think that was a great ending to an overall great podcast. Thank you thank you everyone for listening. If you have any questions about the information that we did go over within this podcast, please drop a comment within the comment section below. What I will do is put within the description box, or whatever you call it, I will put links to some of the information that we did talk about, looking at dynamic yield curves. Also, I will put in some links to just some simple stuff like looking at the graph or the chart for velocity of money, the balance sheet for the Fed, all that stuff. So I will incorporate that. So thank you very much for listening, and until next time, have a good one.